Most business owners wake up in the morning of June 29th and think, time to start tax planning. I hate to break it to you, but there's not much you can do the day before the end of financial year. Effective tax management is all about planning ahead. At my accounting firm, Box Advisory Services, we make sure our clients have a clear plan throughout the year, so they're not stressed out by the end of June. So today, I'm sharing a coaching session I had with my clients and my team, where I go through effective ways to maximize tax deductions and write-offs, timing your income and expenses for tax efficiency, real-world case studies, and common tax planning mistakes you should avoid. Let's get into it.
When it comes to tax planning, there are actually three main ways to minimize your tax that I tell clients. One way is shifting your taxable income away from your personal name or from other entities. So for example, if you had all your income in your personal name as a sole trader, one way of reducing your taxes or minimizing your taxes is actually shifting that to a company. So the company tax rate is 25%, whereas your personal sole trader is 47%. Some accountants say that that's a lie. There's no way that you can actually reduce your taxes. Technically, if you end up taking that profit back into your personal name, yes, you have to pay the 47%. However, if you move it into a company and then reinvest it in a company, then you're paying that 25% for a short period of time. And then once you make a good return, you can move that back into your personal name. And yes, maybe you might have to pay 47%, or maybe you're retired by then and you don't actually earn any income in your personal name. And then as a result, you can balance the income or the profits that you made through that company. And you've already paid 25% tax, so you don't pay too much in your personal name after that. So that's the first method. The second method is increasing your tax deductions. So increasing expenses. So your profit then as a result is less and your taxable income is less. So therefore you pay less tax. So such ways is like putting money into superannuation, prepaying expenses, putting expenses through the business, finding expenses that you may have paid already that you think is related to business so you can claim those expenses. And it's funny, some clients, one of the mistakes they do is forget about expenses they paid in their credit card or their personal bank account, or they borrowed funds to pay for an expense. And because it doesn't come out of their bank account, they forget to tell their accountant. And as a result, they've missed those tax deductions. And so we go back and fix those mistakes as a result. So that's the second method of claiming tax deductions to reduce your tax. And the third and final way is reducing your income. That sounds weird. Why the hell would anyone want to reduce their income? So reducing your income doesn't mean that you just don't make any money. What you could essentially do is maybe push back some of the income for that financial year. So let's just say, for example, April to June, you realize that you don't need to actually do this job. You've got this job that's in place, scheduled for June. You can invoice it now, but then you decide, you know what? You want to take a break. You want to take it easy. You don't want to pay for the taxes early. So as a result, you tell your client, hey, let's schedule it in July. I'll send you an invoice 1st of July instead. So that means that your income actually reduces. So therefore, you don't actually have to pay the tax on it for this financial year. So that's actually a method that accountants actually don't tell you much about. And the reason being is because it's too late. Accountants can't tell you that because they have the meeting after 30th of June. And once they have the meeting with you after 30th of June, your income's already set because whatever goes into your bank account, whatever gets invoiced, it's already done in the accounting system. So it's very hard for us to advise you on ways to minimize your tax by reducing your income. So you don't really hear about that strategy that often, but it is a method. For some of the hospitality businesses, unfortunately, you can't just close up shop for the week. You still have expenses to pay. So it's probably not a good idea. But yeah, for the service-based businesses, construction businesses, they can push jobs back. Yes, it does reduce your income. However, it means you're delaying your taxes until the year after because that income falls in July, which falls in the 2026 financial year, which is due, the year after. So it's still a lot of time. So they're the three main ways. The three main ways is shifting taxable income into other entities that have a lower tax bracket, increasing your tax deductions, and then reducing your income. One side note is if you haven't prepaid your income taxes for the year, so that's via PAYG withholding or installments, and this generally happens when it's your first year in business. So you haven't prepaid any income tax. So just because you pay GST doesn't mean that you've prepaid your income tax. Just because you paid your employees' wages doesn't mean that you've paid any income tax for the year for your business. So most likely, if that's the case, you won't get a tax refund, okay? But some people think that like because they just started a business that they're going to get a tax refund like how they used to get when they were an employee. So I just want to point out that like if you haven't paid the taxes for the company throughout the year, most likely you won't get a tax refund because you'll have to pay taxes at the end of the year because you made a profit. And if you didn't make a profit, you don't pay taxes. That's how it works. I'm going to go into I think there's like 10 ways to minimize taxes, the strategies. So if you have any questions, feel free to stop me anytime and ask me questions. First things first, I'm going to open up a P&L. So let me just quickly share my screen. The first step is of minimizing your tax is prepaying expenses. And this is a profit and loss. So this profit and loss is multiple years, but we don't really need to look at the multiple years. Let's just look at the last 2 years. So let me just hide that just to make it a lot easier. So step one is actually looking at, it's actually not step one, it's step two. Step two was increasing tax deductions. So looking at your P&L for the year, so this is for 2024. So 2024 has already been done. But if you want to look at 2025 financial year, what you do is go into your accounting software like Xero, make sure it's all reconciled up to date, up to like March or up to February, and then look at your income as well as your expenses. So what I'm generally looking for is expenses that you can prepay. So what are expenses that happen the year before and happen this year and they are large expenses? So in this case, for this business, they have these expenses here, which is cost of goods for contractors and wages. These are expenses you kind of technically can prepay. And these also like commissions is probably something else that you can probably prepay. What it happens quite often is subscriptions. These things here are expenses that are for the whole year, so you can actually pay those. Other expenses that you can also claim is insurance as well. So what we're looking for with the Tax Act is the Tax Act actually says that any expense that you can prepay up to 12 months, so you can actually utilize for 12 months, you can actually claim in this financial year. So it's a very handy tool for you to bring forward expenses that you want to claim and you don't want to claim it in 2026. So if you know you're going to be paying for this in July, August, September, then maybe possibly look at bringing forward those, calling up your insurance company, or even booking the airfares that you were planning to book and claim those as before 30th of June. So training seminars as well, if you've got like training that you want to do that's booked in for say December, you can give them a call them to send you an invoice early and then pay them up front as well. So these expenses are expenses that you're planning to pay again in the next 12 months, but instead bring them forward to June or May and make the payment earlier. By doing that, that means that you can actually reduce your net profit, and as a result, reduces your tax. Okay, so again, like I said, the main common things that you probably could claim are insurances, subscriptions, motor vehicle expenses, training, travel, subscriptions. Let's see, repairs. Repairs is also something. So some of these repairs that you had to do in the office, instead of, like I said, you don't actually have to do the work straight away. So you can still prepay for it. As long as it gets done, the work gets done in 12 months, then you can still claim it. That's the rule. Office equipment and office expenses is also something that you can claim. Client gifts, like buying gift cards for your clients, that could be tax deductible as well. And then, wages. Okay, so wages, obviously you can't really prepay wages. It's kind of stupid to do that because the guy can just leave. But if you're thinking of paying a bonus or some sort of commission to your employees or your team members or contractors, maybe that's a good idea to do. You could bring forward July expenses like wages. I don't generally think that's a good idea sometimes because then you have to deal with making sure that they are efficient with their job and they're getting paid early. But if you do trust your team members, you could bring forward these expenses. Okay, so sometimes people then go and asking, Davie, well, if you do that, then what happens to next year? Like you're just basically delaying your taxes. Exactly, you are right. You are delaying your taxes. But by claiming all the expenses here, then that means that next year you will have less expenses to claim and therefore you'll pay more taxes. My argument towards that is that if you have more money to invest in your business early on, you'll be able to grow your business a lot more. Okay, as long as you spend it on smart things. I'm not telling you to go buy a Lamborghini or a G-Wagon for your business because then you're getting a tax deduction for it. It's a bad idea. What you should be doing is spending on money that your expenses that you're planning to spend on anyway to be able to get the tax deduction for it. So you can be able to reduce your taxes. So therefore you have more cash to be able to reinvest back into business. And then eventually you'll end up paying the taxes. So that's the whole point. The whole point is eventually you will pay the taxes. And so therefore it's not that bad an idea to do that. The next thing I wanted to talk about is increasing your superannuation contributions. These entities here, like having a trading trust or having a trading company, is usually the method that most businesses have. They either have a company that trades or a trading trust, or maybe a mixture or hybrid of both, where they have the company that trades and then the trust as a holding entity like this, something like this. So what I want to show you guys is the tax rates for each section. So this trading company usually gets taxed at 25%, whereas this individual or multiple individuals in the business will get taxed at anywhere between 0 to 47%. So that's a big amount of range. But generally, if this person makes 80K to 100K, their tax rate is already at 30%, okay? And then in the trading trust, people get confused about this, but the tax rate for a trading trust is actually, a trust itself, a holding trust or family trust, they call it, is actually nil. It's NA, not applicable. And the reason being is because a trust acts as a way for you to distribute your profits. In the end, the trust doesn't actually pay taxes at all. The trust has to pass the profits somewhere. And usually the profits get either passed to an individual or back to a bucket company here. And so if you have a bucket company here, you're going to limit your tax at 30%. What they don't notice is that a superannuation fund is actually taxed as 15%. And you don't have to have an SMSF for it to be taxed at 15%. Your actual industry super fund can also get taxed at 15%. So when you look at your structure overall, and remember how I mentioned about like structuring and shifting income, our job as an accountant is to look at your structure and maybe possibly redistribute profit or income in your business or your structure or your whole group to be able to minimize your tax. So we'll be utilizing bucket companies, trading companies, super funds, and also your personal name. That's what we do. And our goal is to keep it between 25 to 30%. It'll be great to put all your money into super, but the problem is that you won't be able to access your super until you're 60 years old or older. So the second step leading towards that is actually to move some of the money into super. And so you can actually contribute money into super. And the great thing about super is that you would get taxed at 30%. So let's just say that you made about $100,000 in income in your personal name, right? And then your business made about 250K. You have a limit of how much super you can put in. But because you paid yourself 100K, you get taxed at, you get super of 11.5%. So your business already paid 11,500. What you could do is actually put in up to the full limit of super that you can put in, and that's called concessional contributions. So in Australia, you can actually put in up to $30,000 in super as of 1st of July 2024. And so because you've already only put in 11.5, you can actually put in close to 20K into super. And by putting 20K into super, normally you would have got taxed at this times 25% for the 250K profit. But because you're putting the 20K in now, we'll say it's 19,000 just to be safe. Then what would happen is that minus the 19,000, then times 25%, then it goes down Oh, sorry, it's not minus, it's plus. 250K minus 19K, and then your tax goes down to 57K in the company. But what happens in your super is then that $19,000 hits this super fund plus your 11,500 that's already been paid by your employer. And then what would happen is this plus this equals to this. And as a result, you get taxed at 15%. So you get a lower tax rate. You pay 4,500 in the super fund. You normally don't even see this because you don't manage your super fund, but then it's lower tax rate as 25% and it's a lower tax rate of 47%. However, the only bad thing about this is that you can't access it until you're 60, 65. There are strategies. If you watch my deep dive about super funds and SMSFs, there are strategies on being able to get that money back out by, selling a commercial property into it or, redrawing after pension and all that stuff like that. But that's something for another day. So just to explain how these concessional contributions caps are, is concessional contribution caps basically means that you can claim this as a tax deduction. You can put this money into super, claim as a tax deduction in your personal name or in the company. And the max you can put is 30%. I just also want to mention though, there is a rule. If you haven't used the unused cap that previously, you can carry forward that unused contribution cap. So what does that mean? It means that basically if your super balance is under 500K, the ATO says that for the last 5 years, if you haven't utilized that $30,000, in previous years it was 27.5 and 25K, but say it's 27.5 and 30K. And the previous years you only put $10,000 in or $7,500 in. You actually have in the last 5 years, 20K each year to be able to put in. So you can actually, if you've got a massive capital gain, you sold a property and you're close to retirement age, maybe it might be a good idea to put like a whole $100,000 into super because you can use the unused cap of previous years. Like I said, if you're young, might not be the best idea because you can't access it, but it's better than paying taxes of 47% because you sold this capital gain and made a lot of money on it. You could actually put it into a super fund. And if your idea was to buy an asset with that, when you sold your capital gain, a capital asset, and then you're going to rebuy something else, it might be a good idea to move it into super and buy it in the super fund instead. So they're the options that you could do. And it's actually quite helpful using super to minimize your tax. Sorry, I can see some of the questions now. So SMSF, yes, is the self-managed super fund. Like I said, you don't need to use the SMSF. You could use the industry super fund to buy assets, investments. But when you're generally trying to borrow money or buy a property, then most likely you'll need a self-managed super fund because a lot of industry super funds don't tailor towards buying a property in the SMSF. Does the extra 19K come out of the business or out of the employee's salary? Either, doesn't matter which way. It just depends how you contribute it. You can contribute it as a employer contribution, or you can contribute it via the individual. When you do the individual way, you have to lodge a form. The form that you need to lodge is, I think it's called an intention to claim form. So let me just quickly pull it up. So if you're putting it in your personal name and doing a personal tax deduction and you're getting it from your personal bank account, you need to ensure that you reach out to your industry super fund or your SMSF, and then you fill out this form here. It's an intention to claim, and do this before 30th of June, I recommend, and then give it to your accountant. It's not that hard to fill out, but yeah, you can't just put money in. You actually need to register it with your super fund. All right, so that's the first two steps of being able to minimize your tax. The whole point is like either reducing your profit through claiming more expenses. They were the two main ways. Okay, so another way to reduce your expenses is actually using the instant asset write-off. So the instant asset write-off is really, really simple. It's basically you buying assets for the business. There's a rule. So this is back to the P&L again. So right now the P&L of this business is 467,000. So assume that we haven't reached 30th of June yet, and we're say May 2024. May 2024, we look at the profit and we're like, wow, we're going to be making close to $500,000 in profit. However, I need to buy a new motor vehicle. I've had my one for 6 years, and I need to upgrade now. So you can actually put in a motor vehicle as a claim. So you can look at motor vehicles you can buy. These days, if you looked at my deep dive about motor vehicles, you can buy a FBT exempt motor vehicle, which is an electric car, of up to like $80,000, $90,000. But say you bought it for 60 grand, you can claim the $60,000. However, because it's depreciated, you can't claim the whole thing. Because it's over $20,000. But if it was under $20,000, you can claim the whole thing up front against this $467. But because it's depreciated, you can only claim a percentage of it. And that percentage, I think it's 15% the first year. And then the year after that, it's 20 or 20 something percent. Let me just double check. 15% upfront the first year. I think I saw it just then. Yeah, 15% upfront, and then each year after that, 30%. Yep, so I was wrong. 15% you get a claim at the upfront, and then after that you get to claim the 30% of the running balance. So that's what you can claim against your P&L. So the next year after that, you can claim 30% of this. That's how depreciation works. So you get to claim that, and that goes into here in depreciation. I don't have depreciation here because I removed it, but then it will basically come off here of your profit. So instead of you paying 25% of tax of like 116K, instead you'll pay at the first year, you'll get a deduction of this. And then that's 2,250 just to save by spending 60 grand. However, do you spend cash of 60 grand? It just depends. If you're getting a loan to be able to pay for this, then most likely you won't be spending the full 60 grand straight away. But just take note that, remember, you only get to claim back the tax deduction, like I said before. You don't get to claim the whole 60K and you don't pay tax of 60 grand. It's only the 25% tax against your expense. One thing a lot of people make mistakes on is, you know how I mentioned about putting money into super? You get to claim the tax deduction on putting money into super. But the ATO has this rule where you have to pay your super for your employees I think 28 days after the month end or the quarter end. So your payment for June for super, April, May, and June, actually gets paid in 28th of July. So the ATO doesn't allow you to claim the tax deduction on the 28th of July superannuation payment, because that superannuation payment, even though it's for April, May, and June, was paid after the financial year. So therefore, you can't actually make a tax deduction for it. So what we try to advise our client is, because you're going to actually pay that tax deduction anyway, why don't you prepay that expense for super before the month actually finishes? So on the 20th or 15th of June, work out what your employee's super is going to be for the whole quarter, April, May, and June, and then just pay that earlier. If you're wrong, it's okay. You can make an adjustment. But the cool thing about it is if you actually make the payment this side of the financial year, you can actually reduce your superannuation payment. So the super rates in Australia is actually changing. So super guarantee is it's gone up from 9% all the way to 11.5%. So for this financial year, it's 11.5. But if you make the payment in July, the ATO is going to actually ask you to pay for 12%. So you're actually going to pay 0.5% more if you make the payment after July. So good idea, if you just want to be cheeky, to stay on the 11.5% tax bracket, is pay your superannuation for April, May, and June before 30th of June. And therefore, you can save yourself a 0.5%. It's a small amount, but it's also, good money saving method. Okay, so another way is if you're a service-based industry and you send invoices out to clients, because you invoice clients, you'll see that a whole bunch of your invoices and your income will show up here, and you're on the accruals method, they call it. So basically, you treat your income as income when you send an invoice out, not when you receive the money. If that's the case, and you issue invoices through Xero, that means that you can actually, some of these invoices that you've sent out could not be recoverable. If they're not recoverable, then you should look at some of the invoices and take up bad debts. The easiest way to do this is go into your Xero file or your accounting software, then go to age receivables or look at your invoices and, reorder them on the latest unpaid invoices, the earliest ones, the ones that haven't been paid for a very long time. You're talking about 60 days plus. Check if they should be written off. If you do that and write that off before 30th of June, that then becomes an expense here in your profit and loss. And as a result, will reduce this 467. So I might have like a bad debt. Like I've sent an invoice to a client for say $10,000. That client went bankrupt. It's closed down the business. Most likely I'm not going to receive it. So as a result, I will take up a bad debt against that invoice. And then what happened is that $10,000 income will be then offset by another account called bad debts here. And then it'll be like $10,000 here as well. So that means that I don't need to pay the tax on it and the profit will reduce. They're the main things. They're the main ways to minimize your expenses, increase your expenses as a result, then reduce your taxes. Then let's talk about another method, which is the timing. Remember how I mentioned to you, the third option is reducing your income? Some people don't like reducing their income, but I actually think it's a good idea depending on what type of business you have. So if you have a service-based business like myself, I invoice my clients on a monthly basis. However, the work actually gets done in sometimes the month after. So I get clients to put a deposit down or prepay some of the income, some of the fees, and then I go and do the work the next month or the month after. So sometimes what I'll do is I'll export my P&L for in a monthly turnover method. So like, for example, I might look at a profit and loss. And that profit and loss, instead of it going annual, it'll go all the way from July all the way to June. And then I'll look at June income and then go, some of these June income that I was going to invoice, maybe I shouldn't invoice it yet. I should delay it. Because the reason being is because I don't want to do the work yet, or it's just not worth invoicing the client and then having to pay the tax on it when I do my tax return. So then I will have a discussion with the client. You have to have a talk with the client first before doing it, and then tell them that, hey, I'm looking at invoicing my income or my fees after July. What's the result of that? That means that then your income will drop. So if I could find like maybe possibly some invoices that I don't want to actually do the work for in 2024 financial year and push it into 2025, then as a result, this would reduce my profit by $50,000. It's a substantial amount. Like I said, the whole point of that is just delaying it, and then you end up paying the taxes anyway next year. But you got to be careful. You can't be scheming and just pushing invoices over. There has to be a rule where you're not actually doing the work this financial year, you're doing it next financial year. The next one is that a lot of people don't know about is what happens in your business is that sometimes you kind of draw money out of your company. So let's go back to this scenario right here. So what I've seen clients do is that they usually pay themselves anywhere between $45,000 to $100,000. And what they do is that this is probably a advice that you either heard from us or you heard from a previous accountant, and you've stuck by 45 to 100K. And the reason being behind that is because your tax rate for 45K is, I believe, about 16% for anywhere income from 18 to 45K. So that's why people like to stay on that tax rate, because it's the lowest tax bracket. However, 16% can go all the way to 30%, and it can actually go a bit higher to 120K because you're still stuck with the 30% tax rate now. 135K is what you can go under. So people generally, businesses will pay themselves this much only. And then what would happen is that they'll make all the profits in the company. So say that your company made an extra $300,000 in net profit, and then you've estimated that that's what you're going to make. The company will then pay 25% tax, $75,000. And then in your personal name, you'll pay anywhere between 16 to 30% in taxes for this amount here. So it's quite a low tax. But what clients generally do, because they can't actually afford to live off 45K minus the tax in their personal name, so they start drawing money out of the company, and they draw that money through drawings. They take out drawings and they just withdraw out of the bank account. This happens so often in the financial year. And what we as accountants do is go, all right, well, you've taken this much money out of the company. And if you've done my deep dive, I think it was like 2 weeks ago or last week, there were three main ways to take money out of the company. The first way was wages. And the wages actually, you withhold taxes. So the taxes have been taken care of. The second method is dividends. So dividends is also an option. However, the tax needs to be paid by the company first before you can take the dividend out. If you don't do that and you take the money out earlier, it's considered an unfranked dividend. And that means that the company hasn't paid the tax. The company's still going to pay the 25%. And then in your personal name, you're going to also pay taxes on that too. So that's the way where clients actually get double taxed by them, by the ATO. That never happens with us. And the reason being is because we would actually choose to change that dividend to a loan instead. And they call it a Division 7A. So we will advise our clients to take up a Division 7A loan. That means you have to commercialize the loan, treat it as a loan properly, and then you either pay it back to the company before 30th of June or before the due date of the tax return. And as a result, it's not treated as income in your name personally. So they are the three main ways you have to work out to try to minimize the tax. The first two methods, wages and dividends, results to taxes that has to be paid, whether it's in the company or whether it's in your personal name. And then the third way is there is no tax on it. So if your business isn't making any money and it's not profitable, say it's like, in the minus of $50,000, then it might be a good idea that if you're actually taking money out of the company, you take it out as a loan. And you can offset that loan against, money that you've already paid to the company already. So it just depends. It depends on your situation. So I think when I was doing the Division 7A, drawing money out of deep dive, drawing money out of your company, I had a scenario where I said that if your business just started off and you invested a whole heap of money into the business, that company still owes you that money. So you can actually draw money out. So there's no point paying yourself a wage or paying yourself a dividend from the profits and then paying taxes on that. You can actually still draw back on that loan that you've paid to the company. So the same case can apply in this situation. If your company didn't make a profit for the financial year, then maybe we should even think about reducing your wages and taking it out as a loan. Doesn't have to be a Division 7A loan. It could just be a repayment of a loan, or take it up as a Division 7A loan. And then possibly once the business makes the profit, we can then switch it next year or the year after as a wage or a dividend. So that's one method. If you're taking too much money out of the company, you might have a massive drawing account or director's loan account. It's very important for you to go into your Xero file or your accounting software and then check. Because if you're actually taking that money out and you have, then before 30th of June, we need to do something about it. Or the ATO will treat it as a dividend. And if they treat it as a dividend, that means that your income with the wage will get added on extra income from the trading company as a drawing, and then the ATO will treat it as a dividend. So you'll get double taxed. You'll get taxed in your personal name for that profit that you've taken out, and you'll also get taxed in the company at 25%. So it's not a good idea. And that's why when you're doing your tax planning, always look at your director's loan. So one thing I just also have to remind you guys is trust distributions resolutions. So if you own a trust, a family trust, we would normally email you and remind you to do a trust distribution resolution. Sounds very confusing, but because you own a trust, like I said before, a trust can't keep the profits. So at the end of the financial year, there's a rule that the family trust needs to determine how much profit it's actually made and then distribute the profits at 30th of June to the beneficiaries. It could be the individual, it could be the bucket company, it could be the trading company. Okay, the funny thing is that sometimes, and most of the time, at 30th of June, you don't actually know what the profit is in the family trust because, dividends hasn't been paid, or it could be because, you're still working on the working papers and Xero, the accounting software. So you don't actually know how much the family trust has earned. So what you should do is just quickly generate like a report, a resolution. A resolution is just like just a statement to say that the family trust family trust's profit, you don't actually have to state how much the profit is, but you can state that 100% of the profit goes to, individual 1 or individual 2, or split 50-50 between the family members, or you can go straight to the bucket company. You just need to generate a resolution or create a statement to say something like that, and that's all you need to do. We will generally send you an email to remind you to do something like that. So we have that in writing, that it's been documented that you have been advised to do it. It's just a reminder. It will get generated on the 30th of June. Like you would generate one in 30th of June. It just needs to be documented. So we'll remind you before 30th of June if you have a trust. And I just want to let you guys know about that, because before 30th of June, it doesn't minimize your tax or anything like that, but it's just something that you need to remember to do. One thing that's really important during tax planning period is actually looking at your structure as well. So remember how I mentioned to you the two main ways was reducing your income, increasing expenses, but the third method was shifting your income elsewhere. So what I mentioned previously is that the tax rate of your company is 25%, tax rate in your personal name is 47%. A lot of businesses stay as a sole trader because their accountant too lazy to change them. But you can see automatically the company here and the tax is at 25%. It's actually lower than the individual. So sometimes shifting from a sole trader to a trading company is actually a better idea. Or even shifting and having a family trust here as well, because you might have multiple individuals in your family group that has a low tax rate. So mum and dad might be in a low tax bracket, and your kids might be. The kids have to be over 18. You can't transfer money over to them. I want to just debunk this myth. So minors under 18, tax rate. I just want to quickly show you guys this, because everyone thinks that they can just pop out kids and then just minimize their tax by distributing profits to their kids. Back then, 10 plus years ago, when I was a kid studying accounting, it was actually a strategy. So a lot of people set up trust, distribute profits to minors, maybe just like they just had a kid and they can distribute 18K or $10,000 to the kid's name. But nowadays, the ATO released this rule ages ago, probably about 10 years ago, that says that tax rates for residents who are under 18 for the 24 to 25 year, they can get about $416 and they don't pay taxes. But from $417 to $1,300, the tax is 66%. Crazy, right? It's even higher than the adult. And then from $1,300, it gets to 45%. So obviously, accepted income is excluded out of this. And what does that mean? Accepted income is a fancy word, but I think wages is accepted income. So you can let me just try to find it. Where's accepted income? So you can pay wages to a person under 18, and it's not taxed at this tax rate. But if you earn if you're distributing it through trust, you can't do it. They've blocked that loophole 10 years ago, but people still think it's possible. I don't know why people still think it's possible, but it's not possible anymore to use a minor to minimize tax using a family trust. You can still pay a minor, like a 15-year-old, all the way up to 17. I believe that works for you part-time during school holidays. However, you can't pay him during school hours, because it's pretty obvious that you're doing something, you're scheming. So just understand that you only can pay under 18-year-old during school hours, so they can't work the full-time rates, just so you're aware. Cool. So that's one way of minimizing your taxes. Possibly paying under 18 or hiring people. That's one way. But yes, if you want to use trust distribution to minimize taxes for minors, you only can actually distribute $416 that has a no tax rate. It's not even worth the hassle of doing that, because you most likely have to get a tax file number and then it's added into the trust, and then it will just cost you money to use a trust. And then the accounting fees of doing the trust, it may not be worth minimizing taxes by distributing $400 to your kid that's under 18. If they're over 18, that's a different story. If they're over 18, then we can look at distributing profits to individuals. And same goes with mum and dad. Okay, there is a rule that came out now. I forget the section and what it was, but basically it states that moving forward, you actually have to physically make the payment to that individual. So you get the money into the trust, then the trust actually has a bank account and distributes the profit. So it doesn't have to be distributed on the 30th of June, but just make sure that you have to make that payment after 30th of June. If you make the payment, then there's nothing to worry about. The ATO has been very tough on taxpayers when it comes to trust now, and they're scrutinizing the trusts a lot lately. That's why I generally like companies a lot more now compared to trust, but the trust is still very useful because it gives you flexibility. Cool. So that's what you need to do. At tax planning period, we look at the whole situation. We look at how much money the company's made. We look at the individual and how much the individual's made and these individuals. And then we plan. We go, all right, well, individual one has made $150,000 and its tax bracket is too high. So we won't be, the tax bracket here for 150K is 37%. So we won't probably most likely distribute any profits over to this individual anyway. But however, this individual is zero, this individual is zero. So therefore, that's a low tax bracket, obviously. So we can try to distribute some of the profits in this trading company. Say it's about $500,000. And we will then pass that profits to the family trust. And then the family trust goes to this individual and this individual. We'll give some to here. And we might pay up to 100, 120K and get the tax rate of roughly about 30%. Yeah. So that's what we'll do. Obviously, the effective tax rate isn't this, but what we're trying to do is balance the taxes. We're trying to look at the whole group as a whole and go, all right, the profit in this company is 25%. If we gave everything over to this individual, it's going to be 47% for every dollar over 190K, which is not a good idea. So therefore, we'll balance it with these individuals. But take note, like I said before, the money actually has to go from this company over to this family trust and distribute it over to the individual. Money actually has to transfer. Back then, didn't need to, but the ATO is a lot more harder on you guys about that. Okay, so let's just say we transfer money over here, here, and then we've got like, say 100K in each side, right? Then that means that it's only minus 200K here. So there's still another 300K that we need to get rid of. We could just leave the profits in here. There's nothing wrong with leaving the profits here and paying taxes for 25%. However, you might decide with this leftover profit of $300,000, you might want to invest it. And if that's the idea of looking at investing, then maybe you should distribute this profit, the 300K, into the family trust and then give it to the bucket company. Sure, you're paying the extra 5%, but then the bucket company can invest it and the money's safe in the bucket company because it's away from this trading company. So there's something called asset protection, where you're splitting your assets and removing your profit that you made in your previous years away from your trading company. There's still a risk always to have profits sitting in this company because you're still working with clients, you still can get sued, you can still make a bad decision one day and it could affect the business. So it's actually sometimes a good idea to pay the profits out, and paying the profits out into a bucket company, then you know that it's safe. It's safer than having all the profits sit in this company here. So sometimes they would like to pay the profit over here. However, like I said, there is not just one way of distributing profits. You can pay, I think someone suggested, can I pay profits into a super fund using the company? Yes, you can. So you could actually, use the concessional contribution rules, which is up to 30K, put $30,000 into your super fund. And you can look at the last 5 years, any unused super contributions that you haven't put in, you can put up to 30K per year. So that's, you can maximize that. Say that you haven't input any super at all for the last 5 years, then you really technically have about 150K that you can put into super. Sorry, not fully 150K because the balance was less previous years. But say it's about 27,500 previous years. It's about, you can put about 130K each person too. So you can have like mum and dad put that in. So you can actually reduce quite a fair bit of this profit by putting money into super. Okay, then you can use that money into super to do something about it. So that's what I mean by restructuring, redistributing profits, balancing it through different entities, using a super fund, using a trading company, bucket company, individuals in your family via family trust. However, if you didn't make profit, then don't look at doing this structure, because the thing you got to consider is the amount of accounting fees, setup fees that you have to pay to use something like this. It's only viable or worth it when there's a lot of profit in the business. If there's not much profit, then really, let's just keep it simple. You don't really need all of this. You can just remove all of these and just have you and the company. That's it. It's just quite simple, 25% and 30%. Stick with that because it's just easier. And it doesn't cost you that much. A lot of people think they need like a Lamborghini or a Ferrari of like a structure, and then they end up paying so much cost in maintaining it, and then it ends up being a waste of time and a waste of cost. I want to firstly just recap and remind you guys on what things you should look out for. All right. So things that you need to look out for when you're doing your in a financial year tax planning. What is your 1 to 2 year goal with your investments and finance? So are you planning to borrow money in the next year or so? Because if you try to minimize your tax, prepay expenses, reduce your income, shift income elsewhere into a company rather than a sole trader, that plays with your profit. That plays with your taxable income. And what does the bank do? The bank relies heavily on your tax returns and your financials. So if your tax return and financials show a lower figure, what do you think the bank's going to do? The bank's probably most likely going to lend you less or not lend you any money at all. So if your goal is to buy a family home, upgrade, buy investment asset, then the first thing you should be doing is consider speaking to a broker or speaking to your accountant about finances before you even look at reducing your profit and reducing your taxes. I hate it when like with the client comes to me and their goal is to reduce their taxes, so they pay no taxes, and they can do that by spending all their money. They spend all their money, and then 6 months down the track, they come back to me and they say, "Hey, Davie, I'm applying for a loan. I can't get it." And I'm like, "Well, I have in writing that I advised you already that if you minimize your tax to zero, then most likely you won't be able to get a loan." And now they're stuck. So they have to wait another year to buy their property or an investment. And then you realize that you've actually made a bad mistake, because if you actually paid the taxes of like say 20, 50K or $20,000 or 50K, you would have been able to get the loan. And being able to get the loan and buy that property, a year later, that property went up in like say 10%. 10% of a $1 million property, you would have made 100K. But the client missed out on that $100,000 gain because they decided not to pay that $20,000 tax because they minimized their tax and put in some strategies. So like I said, you got to consider what your goals are. If it's for investment and finance in the next 1 to 2 years, you need to reconsider minimizing your tax. It's always great to minimize your tax. You always see on social media that people say, "Oh, I'd never pay taxes." If you never pay taxes, you most likely won't ever get a loan. I just want to point that out. In Australia, it doesn't work that way. In America, maybe it does, because they've got all these tax rules and for the rich that help the rich. But when it comes to Australia, the bank rules and the tax laws make it pretty much impossible. It looks like someone mentioned something. Division 293. Yeah, so yeah, that's one of let me just go back. Division 293 is something that you've got to be careful. So that's actually my point 9. So point 9, I'll go to point 9. Point 9 is that you got to be very careful of putting money into your personal name. So if you make about 250K or above, something called Division 293 happens. All right. So Division 293 basically disallows your tax deduction for super. So normally you're supposed to get a superannuation tax deduction. So Division 293, you guys can see my page, right? Division 293. Basically, it's saying that you're too rich. Your income's over 250K. So what we're going to do is we're going to disallow that 15% tax, and we're going to actually charge you that 15% in your super fund or in your personal name, and we'll make you pay the extra super. We're not going to give you that concession. It's so lame. I honestly think it's like one of the lamest things I've ever seen. Like the ATA is basically taxing you more and they don't give you a incentive to put money into to make extra income over 250K. So be careful. Generally, we always try to tell our clients not to, if you can avoid the 250K, avoid it. So don't distribute more than 250K in total income in your personal name. One thing that you need to be careful of is if you've got a child and childcare subsidies, okay? Oops, sorry, I spelled subsidies wrong. Childcare subsidy is a big deal, okay? Once you have a kid, everyone understands that childcare is very expensive, and if your income actually can affect your ability to get childcare. So if your family income's 80 grand or less, you get 90% of your childcare subsidized. If it's 83,000 to 500K, then it's subsidized between 90 to 0%. So again, like I said, some clients actually, it's not about tax savings. It's actually about making sure that they can balance getting childcare subsidy in their personal name as well. So they may not distribute all the profits into their personal name or pay them a wage as well. Okay, if you don't have kids, then you have nothing to worry about. But if you have kids that are, have to go to childcare, it's quite expensive. So you want to get some sort of childcare subsidy. And so during the time that you're sending your kids to childcare, you may decide to keep your family income low. And so what happens? Where do you put your income? There are many ways to put your income in different ways. So obviously in the trading company, obviously in the bucket company, obviously in an SMSF or super fund, or obviously in mum and dad rather than in your name or your family, like a husband and wife's name. They are the ways to minimize your income as a result getting childcare subsidy. So look, is there a ethical thing? I think honestly it is, because it's bloody expensive to, like, you're trying to work, you're trying to make more money. So as a result, you're still paying the taxes. It's not like you want. It's you're just trying to get a childcare subsidy so you can look after your kid as well. So while working, so people would say that you're trying to scam the system. I don't think it's scamming the system at all. What you're trying to do is just make sure that your kids are covered, and you can actually send your kids to childcare while you can work more and pay more taxes. So I don't understand why people say that, like you're trying to, scam the system or something when it comes to Division 293 and childcare. Unused concessional cap amounts are applied automatically. Do we really need to fill out that form? Yes, you do. If you're talking about intention to claim, yes, you do, because you have to personally put in the contribution. So remember, there are two types of contributions. There's non-concessional contribution and concessional contribution. Concessional contributions, you get a tax deduction for in your personal name. Non-concessional, you don't get it. It's after tax dollars. So when you put the money into your super, you don't get a tax savings for it, but you also don't get tax in your super. So you have to fill out that form. It's necessary because the super fund needs to know which super that you're claiming, non-concessional or concessional. So it's needed. I am a bit over time, so I'm going to try to finish this part. Again, what we're talking about is things that you need to look out for when you're doing your tax planning. So another thing is looking out for your director's loan. How much money you've actually drawn out of the company. Like I said before, if you've drawn a lot of money out of the company, the ATO, if they audit your file, can actually treat the money that you've drawn out as an unfranked dividend. That means you'll pay taxes in your company for the profit that you made, but you'll also pay taxes on the dividend, the unfranked dividend, that wasn't declared. The ATO will just treat it as income in your personal name, and you'll get taxed again. So you could have made 100K profit, taken that money out. You haven't paid taxes on it in your company. And then the ATO then goes, all right, well, you've taken 100K out. I want you to pay taxes on the 100K. But then when the ATO looks at your tax return for the company, it's like you've also made 100K and you haven't been paid tax. So they make you pay tax again. So you get double tax. That's how it works. So always look at your director loan, the drawings that you've taken out. If the money that you've taken out can be paid back, it might be something that you need to do, pay the money back. So therefore you don't have to deal with the taxes of the money drawn out. One also important thing about tax planning is actually consider how much money you need personally. Remember how I showed you guys that when it comes to drawing money out, some person was paying themselves $45,000. And the tax rate for $40,000 is 16%. It's the lowest tax bracket, one of the lowest tax brackets. But can someone actually physically live in Sydney at 45K? Probably not. They can't pay rent. Rent is probably going to cover 45K is probably the minimum you need to pay for rent for one bedder these days. Minus tax. So it's pretty much impossible to be able to live off 45K. So you actually need to pay yourself more and bump up your tax bracket most likely. Some people might have savings, so they may be able to pay themselves 45K. And then it brings me on to that next point, which is like, look at the profits. Look at the profits each year. And the cool thing about looking at profits each year and looking at like your future profits and your previous profits, the timing of income and expenses, is you can balance your tax between financial years. A lot of people don't think about that. But for example, I had a client that wanted to pay himself 45K and then keep all the profits in the company at 25% and keep pretty much like 500K profit in the company. And I said, no, that's a bad idea. You should not pay yourself 45K. You should pay yourself about at least 80 to 100K. And he said, Davie, why would I pay myself $80,000 when I'm paying a higher tax bracket? And I said, the reason being is because if you pay yourself $80,000, what do you think you're going to be earning next year? Would your business still be making 500K a year? And he said, yes, most likely it'll be making 500K a year. But from 0 to 100K, on let's say $80,000, your tax is 16K on that 18K. So if I do the effective tax rate, 16 divided by 80, you're paying 20% in tax if to take that money out. So that's still effectively lower than this 25%. I can even bump it up to 100K. And bumping it up to 100K works out to be 25%. Well, 24, roughly about 24. All right, 24% on 100K. Wouldn't it be better to utilize the 24% tax rate and take that money out rather than leaving it in the company? Because if you keep leaving that money in the company, let's just say that it compounds. So that would then double. So next year in 2026, it'll be 1 mil. And then the year after, it'll be that plus this, it'll be 27. It's 1.5 mil. You're going to be left with 1.5 mil. And if you ever take that money out because you want to buy an asset with it, you're going to be paying 47%. So you've lost that 25% or 24% because you kept trying to get 16%. And then the big chunk that you're going to try to take out to buy an asset with it, you're going to be paying 47%. So you want to balance your income throughout the years. So if you know that next year is going to be profitable, you're going to be making more, maybe it's a good idea to take the profits out and pay the taxes of 25, 30% earlier so you can get access to the lower tax bracket, because next year your income is going to be $1 million or something like that. And so therefore, if you were to take that money out, it'll be 47%. So you might as well just pay the taxes earlier. So that's important. Consider your personal spending, and then looking at profits every year in your name. Like, is it worth taking the profits out? Like I said before, the structure of having all these structures here is very expensive. So another thing you need to think about is actually, is it worth setting up these structures? Like if your profit isn't that high and you're making losses, then and you don't know if this investment or this business is going to do well, then maybe it's not a good idea to even consider setting all these structures up, like a super fund, trading company, bucket company. Keep it simple. Company and individual might be the best thing for you. Last thing is if you set up a business and you've got carry forward losses from previous years, take that in consideration because you can actually claim carry forward losses from previous years. You can even look at your future losses. So if you know that next year you've lost a contract, you're not going to make much income, then maybe, like I said, it's a good idea to push some of the income that you're earning into the new year or claim some of the expenses in the new year in this year so you can minimize the taxes this year because next year's income is going to be very low. Yeah, and they're the main ways to minimize your taxes. Hopefully that was very helpful for you guys because it was a very long conversation for me. Thanks, guys. I'll see you guys soon.